we've seen quite different themes and sectors working this year in the stock market, especially if we compare it with the last 10 years, what has worked. Can you give us a little bit rundown on what have worked and why do you think that is?
Sure. So if we go back to the start of last year, I think everyone was really talking about the roaring 20s and how we were going to come out of the pandemic. We were going to see a very, very strong economy as all this pent-up demand increased. And that was a rising tide that lifted all boats. The market was very strong and there was broad breadth across the market whereby we saw strong performances from both energy companies, material companies and technology companies. If you contrast that to this year, the start of the year, and everybody is talking about what? Well, they're talking about war, they're talking about inflation, and they're talking about higher interest rates. And now people are starting to talk about the risk of perhaps a recession. And that's a sinking boat that's effectively taking down with it all sectors, with the exception of perhaps energy, which is staying just above water in the positive.
And it has been quite a one-way direction. The market has almost only bought energy this year. If you look into your portfolio, is there something that can hit by markets and you know, there's this one-way trade you think is wrong? Can you maybe come with some examples where you think, yeah, market is wrong as you indicated?
Well, saying the market is wrong always comes with a bit of a health warning. But if we look at where we see some anomalies in the market at the moment, we always say earnings drive share prices over the longer term. And if we look at companies which are continuing to grow their earnings despite what's going on in the market, we look at companies like, for example, TSMC. If we take TSMC, this is a company that's compounding at 2 to 3 times the rate of the market. What we've seen year to date is we've seen a PE bear market. We've seen PEs on all stocks starting to compress. And that's led to a price fall in TSMC. If we look out further beyond just the immediate future, we see a market that's going to go from 600 billion in terms of semiconductor sales to a market that will need to go to 1 trillion as we consume more and more data, as electronic devices become ubiquitous in our life through the Internet of Things, driverless cars, whatever you think. The winner at the center of this, the only company in the world, one of the most important companies in the world that can achieve this is TSMC. So we think at the moment where TSMC is trading at a level actually below the market, that seems anomalous to us.
Is there other examples?
Well, sure. Other examples, a company like, for example, S&P Global, which is one of the largest credit rating companies in the world. It's down significantly this year. This is again a market that can compound at 2 to 3 times the rate of the market if you go back over 3, 5 and 10 year periods, and we believe will continue to do so. It's effectively a data company, and you know, there used to be an old saying that data is the new oil. Well, we think effectively data is the new cornflakes. It's something that's staple. It's something that we're consuming now every day. S&P Global is in an ideal position to take advantage of this, and we see it as a company that will continue to grow for the foreseeable future.
And we always talk about time frame, and of course your time frame is longer, but is there some thematics that you think that market are simply not willing to discount any giving any future at this point of time, and therefore interesting to look into and as investor if you have a little bit longer time horizon?
Well, at the moment the market is certainly looking at and ignoring compounding and the power of compounding and focusing more on things, well, like the energy sector, that are giving you an immediate increase in price today. So the market has actually come very short term in terms of its duration. And that's pretty natural when you see a really fast and sharp increase in interest rates. We think this is going to be a temporary phenomena. How long remains to be seen, but we've seen this before, and it normally lasts quarters, maybe a year. But after that, once we see valuations reassert themselves and the market find a fair price for interest rates, for PE multiples, compounding takes over again. And some of the companies we've talked about earlier on, these are true compounders, proven compounders, and we think that's where the market is overlooking at the moment.
And I think technology is very much under pressure, and I know that technology is too wide a thematic, but is there something in there you're also still seeing some big compounding effect that will return when prices are normalized or people have a little bit other view on the market?
Sure. Well, I've talked about TSMC. There's also ASML, which is in our portfolio, which is a unique company. It's one of the only companies that can provide advanced lithography manufacturing equipment to shrink everything onto the chip that we enjoy every day onto semiconductor microchips. That's something that ASML do, and they're the only company in the world that can do that. We could see them again continue to compound at 2 times the rate of the market for the foreseeable future. And at the moment, we think that's been ignored